Okay, well, thank you very much to the organizers for including this paper. And thank you to Alexander for describing all of this data that we are going to utilize in this paper as well. We're going to look at, actually here, participant allocations and not at menu changes. But this is joint work with Veronica at Vanderbilt, Clemens at Texas, and Irina at the Federal Reserve Board. Usual disclaimer applies. So the background of this is that we've seen large changes in the recent decades about how Americans save for retirement. There's been a decline in the relative importance of public programs like Social Security. And within the private sector, we've seen a large switch from companies offering defined benefit plans to now offering defined contribution plans. And this, of course, means that more responsibility now falls on households themselves to decide how much they're going to save and how they're going to allocate their savings across the different investment options that they have available. The problem that households face when they try to make these decisions is that it's difficult, and households may not have the necessary information, enough time, or the ability to make these investment decisions in an optimal way. Previous research, for example, by Barber and co-authors has shown that households are likely to sort of grab onto and react to information that's particularly salient and attention-grabbing. So in their setting, that sort of load fees, which when you buy a fund is very much in your face, but households tend to ignore information that is more out of sight in their context, the annual fees. Within specifically the defined contribution setting, participants have shown to do all kinds of silly things, and oftentimes not very much at all. So, for example, participants may allocate in a 1/n fashion, that if you have 10 options, you'll just allocate 10% of your total assets to each of those assets. Households also tend to follow defaults, whether that's default contribution rates or whether that's default investment options, and not change very much. What we're going to do in this paper is to look at a new rule by the Department of Labor in 2012 that tried to improve the disclosures of two key features of these 401k plans. So what the rule said is that employers have to start providing summary statements that clearly list the expenses and the performance of the different options that are available in plans, and I'll show you an example in just a moment, and send this directed to plan participants, with the aim of increasing how aware participants are about these two features, the expenses and the performance. Now, it's important to note that nothing in these disclosures is new. If a participant wanted to know how expensive a mutual fund is that's part of their 401k plan, or if a participant wanted to know how well a mutual fund has done over the last 5 years, you could just look it up. You could go on Morningstar. You'd usually have access to a prospectus, and so you could just find this information. But again, the problem was that you have to go through an extra step and actually dig for this a little bit. And what this new rule does is that it brings these pieces of information more in sight. So here's an example of what the Department of Labor said that employers have to send their participants. So this is from the model disclosure, or part of it. You can see a plan that has 4 equity funds. So in the first column of what was sent to participants, you had to list the names of all of the funds. Second column, the expense as a percent, and also as dollars per $1,000 invested. Some research suggests that investors tend to respond more to dollar numbers than percent numbers. And then in a fourth column, if a fund had any additional fees, like an annual service charge or load charge or something like that, you would also have to disclose that. Now, this is from the model disclosure, and a lot of these options on this graph have these sort of load charges. they tend to be rare in practice in these plans because these tend to be institutional share classes that don't have these. But to the extent that they exist, you had to disclose those too. So that was table 1. In table 2, participants got a similar table with the performance. And what was listed here again is the fund names of all the available options, and returns over 3 different horizons. The 1 year, 5 year, 10 year, and then also separately a since inception return. And in later columns, also the 1, 5, and 10 year returns for a benchmark and what that benchmark is. So our research questions in this paper is, when participants get this table with the expenses listed for all the options, do they reallocate between the different investment options that they have in their plan? And when they get this table on the performance, do they reallocate based on the performance across the different options in their plan? And do we find evidence that this differs across participants who may have different levels of financial sophistication? So to give you a preview of what we find, we're going to find that flows by these 401k participants become more sensitive to expenses after this disclosure reform in 2012. We also find that the flows become more sensitive to particularly short-term performance after the reform, although we find no evidence that participants respond more strongly to 5 and 10-year performance after the reform. And we next look at cross-sectional differences and find that these effects are less pronounced for plans where the participants tend to make lower than average contributions. This is our proxy for financial sophistication, or at least the relative importance of this decision. We also find that these effects are smaller in plans that have many options. So again, for plans with few options, the effects are stronger, and as you increase the number of options, we see a relatively weaker effect. In terms of how we relate to the current literature, I think we speak to at least 2 literatures. First, there's a very broad literature in economics about how information or access to information affects household behavior. You can think about, for example, whether telling people about how much a payday loan cost is going to affect people's decisions about how much to borrow, whether the quality of schools affects where people choose to live and the disclosures of those qualities, whether disclosures of hospital performance affects where people choose to get care, whether disclosures of firm financial statements affect how people decide to invest. The second broad literature that we speak to is particularly about defined contribution plans and the design of plans. So here, as we just discussed, the design is crucially important precisely because defaults matter so much and the available options matter so much for how participants choose to allocate. Now, maybe I don't need to tell this audience that 401k plans are really important. So 401k plans, they are these employer-sponsored defined contribution plans, and they cover more than half now of the retirement assets in the private sector. Alexander had a little bit newer data than I had. At the time, it was over $5 trillion already, and now closer to 6. And 67% of these assets are invested in mutual funds, and that's the main choice we're going to look at. And this represents the main source of retirement wealth for these participants. A few terms to keep in mind. The employee, we're going to call the participant. I don't have a 401k plan, my wife does, so I'll just use her as an example. The employer is often also the sponsor or the fiduciary. These 3 roles are different. They're almost always the same, even though they could be different entities handling these 3 things. And then the provider is often also the record keeper. So Jacqueline works for Decatur Memorial, and the plan provider of that plan is an insurance company called Empower, which is one of the largest for mid-sized employers. Here's an example of a 401k plan. Alexander had a similar graph like this, or example like this. You can see a few things that I want to point out. First, there's two kinds of mutual funds that tend to be offered as part of these plans. So this plan is provided by Fidelity, and you can see that there are two options of Fidelity mutual funds in this plan, and at the same time there's other options that are non-Fidelity mutual fund options. And you can also see that this company, Protective Life, offers their own common stock as part of the plan, and of the total around 192 million, just over a quarter is invested in Protective Life stock, and that's not atypical for a plan in our sample. So our data comes from Form 5500, and what we get from that data is a list of these options and the value invested in each of these options. So we have a panel of that, and then we're going to match that to CRISP to get the information about the fees, which is the last column in this example, and performance. So a little bit more background on the disclosure reform. So this was part of a series of initiatives that the Department of Labor had to try to enhance the information environment around these plans. The rule that we look at is called Rule 404A5, and that's about how the fiduciary, so that's the employer, what they have to tell the participants about the fees and the expenses and the performance. This rule was quite a long time in the making. The first step was a request for information that the DOL did in 2007, and it was about 5 years later that this rule actually came into effect and these disclosures were sent out to participants. Around the same time, there was also something called the Rule 408B2, which was about how the service providers, so the Fidelities and the T. Rowe Price, what they have to tell the employers about fees, both direct and indirect, that they could get for managing these plans. For example, the mutual funds that are part of the plan sometimes compensate the providers for the privilege of being part of the plan. And that rule was first published in 2007 and came into effect around the same time as well. On our data, so we really combine two data sets here. We start with a sample of plans based on Form 11K filings. Form 11K is something that every company that offers common stock as part of their 401k plan has to file with the SEC. Then we supplement this data with an additional 1,000 largest 401k plans based on Form 5500. So after that, we limit the sample to plans that have between 3 and 100 fund options. That's the vast majority of plans. We don't want plans, though, that really have no choice, that have maybe one or two choices. We don't want plans where there are literally hundreds of options, and there are some of those examples as well. So this gives us around 5,500 plan year observations between 2010 and 2013. We're going to look at 2 years before the reform to 2 years after, or around 1,400 plans per year. So even though we don't have a lot of plans, there are over 500,000 401k plans that file Form 5500. We only collect way less than 1% of that, but we have over 25% of the total defined contribution assets in the US, precisely because we sample the largest funds. Then we match these data with CRISP, the CRISP Mutual Fund Database. We do this match at the share class level whenever we can, around half of the time we can. And when we can't, we assume that this is the share class with the lowest expense ratio. Then we exclude any options that are newly added or deleted in the year. So again, we are going to want to look at participant allocations. And so it's important for us to be able to distinguish flows that happen because something gets deleted or something gets added, or something that is being done by the participants. So again, you have to have, we only look at options that exist this year as well as last year and look at the flows for those. We also exclude target date funds. There's the main reason for that is that these tend to be defaults, as was discussed just a moment ago, and but we are going to use them as kind of a placebo test. So in the end, each plan is going to have 12 mutual fund options that are continuing in that they existed last year and this year, and that are non-target date. A few statistics. The average plan size in our sample is around $800 million, and the average plan in our sample has 13,000 participants. And so the contributions per participant is about $4,600. That's how much money on net the active participants are putting in. And these participants on average have around $77,000 invested in their plans. A typical plan has around 21 mutual fund options. So this is now limited to just mutual funds. And of those, 3 are new and around 17, 18 are continued. So they also existed last year. And of those 17, 18, around 12 are the non-target date and the rest are target date. The average fee across all the funds in a plan, if you first average at the plan year level and then take the average of those plan year observations, is 57 basis points. And we're going to ask if people reallocate towards relatively cheaper options. Now that wouldn't matter if most options cost about the same, but we find that there's actually wide dispersion in fees within a plan year. So if you compare in this variable, we're comparing the 10th versus the 90th percentile mutual fund in terms of fees within the same plan year, and that dispersion is quite sizable, about 70 basis points on average. We're going to use 3 measures of fund flows. All of these are going to start with a dollar flow measure, so that's the value that's invested in a fund in a plan this year, less what was invested in it last year, multiplied by the return of that option during the year. In the first flow measure, we're going to normalize that dollar flow by how many dollars in total was invested across all mutual funds last year. So that's sort of a measure of the allocation. The second flow measure, we're going to normalize by how much was invested in this particular option last year. So that's more of a percentage growth of a particular option. And the third measure, we're just going to look at whether flows are positive or negative, whether people are putting money in or people are pulling money out. Here are a few option level summary statistics. Perhaps I'll talk about these a little bit more when I talk about the results. But you can see, for example, that the positive flow indicator, and this was a little surprising to us, an option has positive flows only about 54% of the time, which means that for 46% of options, people are actually pulling money out on net. We're going to always do a comparison within style, and for that we're going to have to aggregate or style categories a little bit broader than Lipper categories, and we assign Lipper codes to one of these 6 fund categories: balanced funds, domestic equity funds, domestic fixed income, foreign equity, and foreign fixed income, and other, which is mostly real estate funds. And what you can see from here is that most of the choice that people have across different funds in the same style is going to be within the domestic equity style. That's where people have on average 7 choices in a plan that are in that style. There is some choice for some, at least in some plan years also, within the domestic fixed income and in the foreign equity, but that choice is much narrower. You really only have a couple of choices on average in those. So here's our result kind of in a graphical form. So what we're looking at here is the percent flow to low fee funds versus high fee funds. So what we do is that we take, we define the low fee funds as the funds that are below the median fee within a planned style year. And we define the high fee funds as the ones that are above the median fee in a planned style year. And we look at the percent flows to each of these two buckets. And what you can see is that in 2010 and 2011, the low fee and high fee funds had about the same flow, about 5%. In 2012, when this new disclosure rule comes in, you can see that the low fee funds see about double the flows of the high fee funds. So people seem to be changing their behavior, and that also persists into 2013. So that mixes across all the different styles. I just told you that most of this choice is going to come from just the domestic equity segment where this choice really exists. And you can do a similar graph where you just define the above and below median fee funds within the domestic equity set. And you see quite similar results. If anything, the high fee funds or above median funds saw higher percent flows in the years prior, and that relationship flips in the latter years. To test this a little bit more formally, we're going to run a regression where we take our 3 different measures of flows and regress that on the lagged expense ratio. And the main coefficient of interest is going to be beta 2 here, which takes the lagged expense ratio and interacts it with whether this is after the reform. And we also include several control variables. The main control variables is a size by year control, where we essentially control for the market share of a particular option in a plan, as well as fixed effects. So our fixed effects include plan by fund fixed effects, which sort of says we're going to look at the same option before and after reform. Plan by style by year fixed effects, which says we're going to take out any sort of aggregate flows to a particular style. So say bond funds get more flows in one year versus another, we can take that out and just look at different expenses within the set of bond funds. And also in many regressions, or in every other, we're going to have fund company by year fixed effects. For example, if you believe that some fund companies are advertising more in some years, or are being more popular, or being hit by scandals, or whatever might happen, we're going to just look at across different funds for the same company. And throughout, we're going to cluster 2A by the fund management company and the DC plan. So here's our baseline test, where we take the first row here is that of beta 2, the expense ratio interacted with post. And what we can see is that this coefficient is significantly negative, which means that people allocate towards cheaper funds after the reform. So higher expenses predict slower flows after the reform. In terms of economic magnitude, this is about 1/3 of the standard deviation in flows, so quite sizable in those terms. We find similar results when we normalize by fund size. And in the columns 5 and 6 here, we are looking at the percent, sort of the indicator variable, about whether you have positive flows or not. And what we can see is that a 1% higher expense ratio predicts that about 20 percentage point change in whether you have positive flows or not, which is a very big economic effect compared to the mean, which is about 54%. You can see that the results are quite similar regardless of whether we include fund company by year fixed effects or not, so it doesn't seem to be related to that. Next, we limit the sample to just domestic equity funds. Yes?
You're going to say something about your very strong identification assumption here, which is
Yep.
that nothing else is going on, right? So essentially this is also a time where people just might be getting sensitive to their investment portfolio just
Yep.
because of the recession, and it might have nothing to do with
Correct.
the disclosure.
Yeah, we're going to be very worried about that. Hold on to your question. Next, we look at just the sample of domestic equity funds where most of this choice exists, and we find, if anything, the results are stronger when we limit it to just this category. So in the baseline results, and let me just show you, so here we have a coefficient on the expense ratio. Because we have plan by fund fixed effects, this coefficient is only identified off of funds that are changing their expense ratio over time and not from the cross section. So it's a little bit hard to interpret. Here we take a lagged expense ratio from before our sample, from 2009, which now is our proxy for the cross-sectional dispersion in expenses across the different objects you have. And we find that our results are very similar if you do that. And here the plan by fund fixed effects absorb the uninteracted expense ratio. So yes, we're very concerned if people are just becoming more sensitive to fees over time. And that's one sort of possible threat to the identification here. So in this test, what we do is that we look at whether, if you ran this experiment around any time, maybe people are just always becoming more sensitive to fees. We sort of know that there's been sort of increased attention to fees over the entire decade. What we're particularly concerned about is if sort of this got stronger and particularly was similar in the years just before the reform, we'd be worried. We don't find that. We do find actually that people became more sensitive to fees in 2003, 2004 compared to the years prior. There was a mutual fund disclosure reform also in 2004, and so that's one possible driver of what's going on here. Although when we limit it to just domestic equity funds, that becomes weaker. You'd think that this would be most extreme for the minimum fee or the maximum fee. So now you're getting this information, and perhaps what's happening is that you're really going to pay attention to who's the bottom one in terms of fees. And we find that, so we take a minimum fee indicator here, and we show that if you're the minimum fee, you get more flows after the reform, or if you're the maximum fee, you get less flows after the reform. And that holds even after you control for the expense ratio itself. So there's kind of a discontinuous effect from being the extreme fund. And that's also similar when we look at domestic equity, although the results here for the maximum fee is a little weak. A lot of our results is driven by an allocation from active funds to index funds, simply because index funds tend to be cheaper. But we also find reallocations within active funds, where this means that people are substituting away from relatively more expensive active funds and putting money towards relatively cheaper active funds. When we limit the sample to just index funds, the point estimate goes in the same direction, although it's statistically pretty weak. Part of what's going on here is that the differences in fees between different index funds in the same plan are usually quite small, so it's hard to really tease that apart. Next, we look at target funds. So we excluded target funds from our previous results. Now we only look at them. And we view this as kind of a placebo test, because if you're invested in target funds, you really shouldn't pay very much attention to fees. You should pick your target fund based on when you plan to retire or when what your risk tolerance is, and not based on which target fund happens to have a slightly lower or higher expense ratio than another. And we don't find any evidence that people are paying more attention to fees for target funds around this reform. We do a bunch of other robustness, including limiting the sample to just 1 year pre and post, fewer fixed effects, no controls at all. We control for changes to plan menus and defaults. For example, we exclude any plan years that have any deleted options. We'll talk about that in a moment. Then we look at cross-sectional differences. So 2 cross-sectional dimensions are studied. So first we look at the average contribution amount. So on average, people contribute $4,500 a year, but we're going to split that on the median. This is going to be our proxy for financial sophistication, or at least the economic importance of this choice. And we're also going to split based on the number of fund options, with the idea being that if you just have a lot of options to choose from, that makes a relative comparison more difficult. So here's our split on participant contributions. So we define an indicator large contributions, which is whether you are contributing more than the sample median in that year. And what you can see is that the effect on the expense ratio is stronger for the plans that where participants make large contribution, about 50% stronger. So if you compare this coefficient here, which is the predicted effect for below median contributions, and add this one, it's about 50% stronger. And then we look at the same for the number of choices. When we look at that, the triple interaction is positive, which means that the more choices you have, the less you seem to react. And in the extreme, if you have 100 options, which is the largest sort of in our sample, the predictive effect is close to 0. So you can see that by taking this base effect and adding 100 of these. We also look at some reallocations across broader asset classes. So first we look at the allocations within affiliated versus unaffiliated investment options. So the affiliated options here are the Fidelity mutual funds that are part of Fidelity funds. 60% of plans have at least some affiliated options, and a lot of money tends to be invested in these. And what this disclosure might do is to level the playing field between these 2 options, because now investors have more information and can make decisions independently. And we're also going to look at allocations between company stock and mutual funds. Majority of our plans have some employer stock, and 50% of assets is invested in this, conditional on having it. An interesting feature of company stock is that if you invest in company stock, you get a 0 expense. But if you invest in mutual funds, you have to pay something. So by telling people about how much their mutual fund options cost, you could tilt investors towards putting money into the 0 expense option, and that could be an unintended consequence. So to test that, our dependent variable here is going to be what fraction of total fund assets is invested in affiliated funds, and we regress that on the fee difference between affiliated and non-affiliated funds. And what this is telling you is that if, for example, the affiliated options, the Fidelity options, are more expensive than the non-Fidelity options in a Fidelity provided plans, people reallocate away from those affiliated options towards the non-affiliated options after the reform. And when we look at the employer stock, what we look at here is similar. The fraction of plan assets that's invested in employer stock. We find that if you're an expensive plan, we take here the average across all mutual fund options in a plan. If you're a more expensive plan, people are going to reallocate away from mutual funds towards employer stock after the reform, when people get this information about how expensive these mutual fund options are. We next look at whether this disclosure performance matters for how people allocate. Our regression is very similar, so we're going to regress flows on performance 1, 5, and 10 year, interacted with post, and also include the expense as a control and the same control variables as in our previous results. And what we find here, on the interactions between the returns on the different horizons and post, is that people seem to be reacting more strongly to the 1-year return after the reform. So the 1-year return was always kind of important. You can see that the people tend to allocate towards funds that have done better last year, but that becomes around 3 times stronger after the reform, so large in terms of economic magnitude. But we don't find evidence that the 5 and the 10-year changes in terms of the sensitivity, although the 10-year sort of always has been important. It's just it doesn't become more important after the reform. So in our previous results, we've sort of always looked at the option level, so an individual fund in a certain plan. What we're next going to do is to try to aggregate this to the fund level. And our empirical strategy here is going to be a triple diff. We're going to look at cheaper funds versus more expensive funds and further interact this with their exposure to the 401k sector. With the idea being that some funds out there are cheap but don't have a lot of assets coming from 401k plans. Some funds are cheap and have a lot of assets coming from 401k plans. And so now the relatively cheaper funds that also have high exposure to the 401k sector could benefit in terms of flows. We can measure this exposure both at sort of extensive margins of whether you're part of plans, and an intensive margin, sort of how much of your assets comes from these plans, and sort of study with the increases in fee sensitivities compared to funds with less exposure. And this can help account for changes in fee sensitivities over time that would be unrelated to the disclosure reform. So imagine that, and this was Bilal's question, imagine that there's something going on exactly in 2012 that makes people more sensitive to fees. Now we can control for that and say, well, look, we're going to look at funds that are specifically part of 401k plans and compare that to funds that are not. And if people were becoming more sensitive to fees exactly in 2012, that should affect all funds and not just the ones that are part of plans. So here's our regression. It's a triple diff. So flow at the fund level now, regressed on the expense ratio post, and our measure of exposure, which is, we have 3 different measures. First, an indicator for whether a fund is included in any of the plans that we have in our sample. The log of 1 plus the number of plans in our sample that includes this fund, and the percent of 401k assets that we have in our set of plans that we can attribute to this fund. So these exposure measures is going to be a lower bound of the actual assets that are attributable to 401k plans, because we only have a sort of a subset of the entire universe of 401k plans. And when we do this, we find that the triple difference is significant. And the way to interpret this is that if you look at the expense ratio interacted with post, and the indicator here, whether a fund is part of any plan, is the easiest one to interpret. Funds in our sample that are not part of any plans become slightly more sensitive to fees in 2012 and 13 compared to the years before. That's sort of the secular trend we've seen, although that's not statistically significant. When we interact that with whether you are part of some of these plans, we see that that effect is about 3 times stronger and now highly statistically significant. So there seems to be something that's particularly about these 401k reform that is driving these fee sensitivities. Next, we look at some changes to menus. So, as Alexander described, there's a lot of changes to these plans, and one concern that we had is perhaps sponsors and providers are changing their plans in some specific way, particularly around this reform, and perhaps that is affecting our results. So that's why we study additions and deletions. So in this graph, I'm showing the fraction of plans that had any additions in each year in our sample. And what you can see is that throughout our sample, about 70% of plans have at least one new fund. There's a lot of turnover or a lot of changes. But this doesn't seem to be more additions in 2012 and 13 compared to before. In terms of deletions, which is the right-hand side panel here, we see that it's reasonably steady. If anything, maybe slightly more deletions in 2012 and 13 compared to before. And that's true also if we look at the fraction of options that are added or deleted. Now, one concern that we had is that maybe particularly expensive or particularly cheap funds are more likely to be deleted after the reform, and perhaps then the assets are going to be moved to a new default that happens to be cheaper, and if that's true, that could drive some more results. We look therefore at sort of whether or not a fund is deleted in a plan, an indicator, on the expense ratio. But we don't find that expenses drive deletions particularly after the reform, after we control for things like the amount of assets that's invested in that fund. Now, none of this is sort of conclusive, but what we can show is that even if we exclude all of the plans that have any deletions, where there might be some money that's moved to some new default, our baseline results are basically the same as in our previous regressions. So here the sample is much smaller, so we only include plan years where there are no deleted funds, and our sample shrinks by almost 80%, but our results stay basically the same. We can be a little bit less aggressive and only exclude funds that have some deletions within the same style, and we find similar results in this slightly larger sample. So to conclude, what our paper finds is that flows by 401k participants becomes more sensitive to expenses after this disclosure reform in 2012, and that's particularly the case for extreme fee funds, the ones that are the minimum or the maximum in the plan, and that these effects are less pronounced in plans where people tend to make smaller contributions than in plans with many options. We also find that these flows become more sensitive to short-term performance after reform, although not more sensitive to longer-term performance like the 5 or 10. And some of our broader asset allocation results point towards a more even playing field between affiliated and non-affiliated options now that participants have access to better information. Looking forward to the discussion and the questions.
So the main question of the paper is whether fees do actually affect the allocations of plan participants among the different choices. So do investors care about fees? I have a very Canadian example. In 2006, there was the working paper mutual fees around the world by Corona, Servas, and Tufano. And that was actually a shockwave to the Canadian mutual fund industry, because it turned out that mutual fees in Canada are among the world's highest. Canadian mutual fund fees are the highest in the developed world. And even in September of this year, we would still talk about it. Canada is no longer dead last in the global ranking of how much is paid in fund fees. Some of the investors, and including the financial press, they care about fees. So Mathias showed you the key picture, which kind of summarizes everything in a nutshell. I trusted Mathias that he'll do a great presentation. I was right, so that's why I showed you just one slide summarizing his results. So you can see the dark bars, the light bars, flows to low fee funds clearly increased after the reform in 2012. Just two minor comments here on these graphs. What you see is a value-weighted average of fund flows. So you'll see the economic importance. Probably what could be interesting as well is because we look about decisions. So does the reform have an impact on the decision of plan participants? So that's why I say an equally weighted average could also be interesting. And maybe one word on what happened in 2013, as clearly flows increased during that particular year. So if you look at over a long time horizon, of course there have been a lot of fluctuations, but say still among the 4 years, 2013 stands out in terms of total fund flows. Now the paper is very careful to explain like how they actually measure fund flows. So they use 3 measures, and then from time to time they also point out why they use the different systems. So one is that there might be outliers if you have small funds, if you do it like percentage in and outflows, and scaling might be in general a problem. So my first suggestion would be, why not try flow rank? So if you look at flow ranks, then you can look at which option actually is ranked in terms of who gets most of the flows, and then basically get rid of problems of outliers at the same time, and you really focus on the decisions, which one would you choose in first place. And at the same time, also my little concern about 2013 would be gone as well, because it wouldn't matter what is actually the scale of how many funds flow within a given year. Then my second comment is on the few choices for many categories. I actually even had like a conversation by email with Mathias beforehand, because everyone is aware that there are these different style categories, and there are obviously some style categories where you have few choices. I added this one, balanced, because the paper clearly explains this as well. We have seen it also in Alexander's presentation. Balanced funds, they often have like many of these target date funds in it. They're excluded from the sample, so even for balanced funds, you're left with a few choices, which of course the authors are well aware of. That's why they show all the results also for domestic equity funds only. But still, it would be interesting to see like if people switch categories. So in those analyses where you do it by fund, by plan, style, and year. So if you look at changes within the style, does it really matter? Do you really like pick for instance, the domestic fixed income choice? Do you pick it really on the basis of fees, or do you pick it maybe on other dimensions? Say, for instance, you could have long-term government bonds, you could have corporate bonds, you could have money market, and maybe depending what performed how in the past, you would select. So I'm not sure whether in those categories we have just very few options, where the fees would be your first order choice. As I said, fixed income. If markets tank, if bonds performed well, maybe you get attracted by the long-term government bond yields. Maybe you get risk averse, you want to get into money markets. So it's not clear to me whether in those categories I would first look at fees. Is that important in their study? I think so. So if investors, they would look at past performance, then you see like 2009, 10. So if they would decide in 2011, they probably would think, oh, stock markets, I missed out on huge opportunities, emerging markets, 78%. But bonds was a bad idea. But that actually, by coincidence, just changed around the reform of 2012. So if they would look back, oh, I would have lost 18% on emerging markets, and probably I should go into bonds. So even if there's inertia, maybe around this reform, people would switch into categories like bonds, where you probably wouldn't differentiate your choice necessarily based on fees, but on type of bonds that you're investing. Of course, as I said, the authors are well aware of this. That's why they always show everything based on the subset of mutual funds, domestic equity mutual funds. So the disclosure also tabulates 1-year, 5-year, and 10-year returns. So now I'm focusing more on the domestic equity mutual fund part. They say, like in the second part of the paper, they find that this 1-year return sensitivity becomes stronger. And I actually think that's a great result of the paper. So we all know there's a lot of inertia in their decisions. But if you find that actually, due to this disclosure, they react to performance, I think that would be an equally interesting result or even a better result than fees, or both together. So I think that part I'll explore a little bit more on it. Why 1 year performance? Your explanation was, well, maybe it's because it's in the first row, so people look more at it. Maybe because there is some evidence of more persistence in the literature, in the short run. But I think that seems to be a natural consensus. Look at all the tournament literature. There's always the assumption that people would look at the 1 year performance. So if I perform badly after half a year, I would increase risk in order to try to end up with a good 1 year return. That's an extract from Richard Evans' papers about mutual fund flows if you have incubated funds. And it's 100% consistent with what you actually find. Expenses matter, but what he shows, what matters is returns measured in different ways. And also one interesting thing, he looks at how much flows go actually in a specific category. Now I'm focusing only on domestic equity mutual funds. So basically he says, well look, investors would invest in a specific category, let's say like small growth, because there's a lot of flows that go into there, likely because in the past performance has been very good. So still, also he finds fees matter, but together with performance. Now if you look at this period again, let's assume that, that's generally accepted, that small funds, they're more costly, growth funds are more costly. If you look what happened before and after the reform, so in 2010, the expensive funds, they performed well, small cap, growth, large cap, and value, typically the least expensive ones performed less, and then it switched. So after all, I'm asking, is it really fees that made people switch between those categories within domestic equity mutual funds? I think based on the results from Evans, it's likely both. But that's why I would even go as far as questioning, should the title have fees and performance? Which I think would even make it a bigger paper. Meaning, you can actually, with this reform, they could break this inertia. People actually all of a sudden started to look at the tables also for performance, not only fees. Then maybe the government would have to think to figure out a new way how to draw attention to this past performance another time. But so to me, it's not clear that it's in first place fees. It could be fees and returns together. And some of those results that you find for fees, they could be natural driven. If you chase performance, you actually go into lower fee funds. Then there's another result that shows, well, people would shift more into index funds. Of course, that also, if you look at fees, 100% correct. That's what you would expect. Now, I happen to find an interesting figure. That was really like by chance I got on this one. It actually turns out that if you compare what is the performance of actively managed funds compared to index funds, then it turns out before the reform, they performed relatively good, but many actively managed funds underperformed the S&P 500. And I think you can actually do this. So, of course, it would be a lot of work to go and check the benchmark for each of your mutual funds that you have. But just looking at the correlations of these funds with the largest indices, S&P, the 4 Russells, I mean, most mutual funds, that's their benchmark. You could figure out what's their benchmark, and you could figure out whether actually a specific actively managed fund underperformed or overperformed. So maybe what you would find is that, yes, people, they would switch into index funds, but probably even more so for those for those actively managed funds, they would take out money if they underperformed their benchmark. Then fund deletions and additions. I think Alexander already had many points on that might be an issue, say how to deal with it. I just simply thought if there would be 2-3 things that would be interesting. If you know what the default options are, we probably could also learn a little bit something. What gets excluded? Is it an expensive fund? So myself, I thought just of a simple table, show like the fees of funds that have been excluded, the past performance of excluded funds, And again, even from those numbers before and after, we could get an idea whether they excluded mostly high fee funds or low performance funds, which one matters better. And you say it is unlikely that the majority of sponsors changed default options at the same time and precisely in 2012. You know better your sample. My hypothesis would have been, I as a plan sponsor would kind of window dress my menu. So I'd exclude the bad ones because I don't want to look bad. And I would say even maybe I would disclose more information before I'm forced to. So I might be wrong on this one, but I had the impression, like all the plans saw this reform coming. Why would you only change your menu exactly in 2012? I could use it as a marketing tool, say, look, we give you all the information. Do I really care so much that I do exclude bad funds? If I have like good funds in my menu that they present, I think my plan sponsors would be happy to see that. So given that I can retire bad funds, put new good ones with good past performance, I might have disclosed this information about the performance already before. As I said, there might be some, the evidence might be different that actually all the plans really change in 2012. So that's what I had in mind, like just per category, and even like for domestic equity funds, I would go into these subcategories because I said I think performance matters. So if we get for fees fees of the additions and deletions, same for performance, then we only would get the first idea about whether they do kind of window dress their menu. Just a short note, also target funds. There seemed to be like a huge increase of participants holding target date funds. That's a comparison between 2006 and 2016. So they're mostly excluded. Maybe there's also some interesting finding in there. What is actually added to the menu? How do investors react to it? Because it seems to be increasing gigantically over these years. Of course, that's a 10-year horizon, but still it includes the time span that you analyze in your study. So it was a great paper, and if my information is correct, it's R&R at JFE. It has been accepted to numerous conferences, among others, this one here. And I think using rank fund flow rank could focus more on what is actually the decision making you do, not only in overall the economic importance. The evidence, if it's an increase in fee and return sensitivity, I think that would even add more to how important this new disclosure reform was. And I think like for domestic equity funds, there would be also even more mileage that if there's enough data to see what actually investors do. So thanks a lot for inviting me here. It was my pleasure to read the paper. You helped me to get back in marathon shape again. And you can zoom in. It's actually Mathias' paper. The other comments are sent to you.
Yeah, thank you. So I'll just briefly, so there's time for questions. We don't find a lot of reshuffling around 2012, and I think that's exactly as you hinted at. Sponsors saw this coming at least since 2007, and so they have been changing the menus over time, and so there's nothing particularly happening around 2012. So why do we focus so much on fees and not on performance? So I agree that our paper is really focused on fees, and then we sort of have performance at the back. I think two reasons. First, we think that fees are more unambiguously a good thing to focus on. If you save on fees, you get higher net returns, whereas if you should focus on past returns, sort of depends on your beliefs about persistence. That's also sort of a point that Alexander pointed out. We're going a little bit in that direction now to sort of look at the persistence. We find some, although we haven't done it carefully enough yet with alphas and that sort of thing. And then yes, so in some years bonds are going to do better than equities and see correlated flows, and in some years it's going to be flipped. So we deal with that, two ways. We have plan by style, by year everywhere to take out those things, and we look at domestic equity. But we what we can't do is to separate sort of between small cap and large cap funds that have different returns and flows, because there's just not enough choice within a plan within those categories to tell. What we do is that we include past performance as a control variable interactive with post, and when we do that, we see essentially similar results. But yeah, good. Extremely helpful discussion. Thank you very much. Well, happy to take questions.
Good question. In literature, people talk a lot about return sensitivity. I'm guessing there are other moments of a distribution that people care about. Why do we focus on return?
Why we focus on the average return rather than the volatility, for example?
For example.
Yeah, so what we actually, it's not in the paper, but we do find that the standard deviation or the variance of return goes down after the reform. That's most driven by an allocation towards index funds that tend to have less idiosyncratic risk in their portfolios, or quasi-index active funds.
So I guess the question would be, if I'm reforming a portfolio, I mean, I care actually about returns, variance, and another thing, covariance. So to what extent might there be some rationalization that suggests that this return sensitivity is not a good thing? I'm just asking. I mean, I know it's nicer to get a good return, ceteris paribus, but it's not obvious until you can tell me, the full distribution, that that's a good thing.
Yeah. I mean, in the end, what matters is investor wealth over the long run.
Investor expected utility, yes, not wealth, unless they're risk neutral.
Yeah, okay. Expected utility over the long run. Yeah, so higher returns, lower variance seems to be a good thing, but maybe there are other covariances we should think about.
But I mean, there's evidence that actually mutual fund investors don't really look that closely at those additional moments, because Evans, he shows that incubated funds, so it was not even investable, but they see a nice return and flows go to incubated funds. Similarly, in tournament literature, basically the plan or the mutual fund manager, he increases volatility over the second half in order of the year in order to get higher in the ranking of returns.
Mm-hmm.
Obviously, if he does this, that means his hypothesis is that in first place people just care about returns, and in second place about the other moments.
So that suggests there's also even higher order moments, as skewness and so forth. Now, the reason I'm raising this is because we've had a lot of problems figuring out how to communicate risk of portfolios to people, and it's very difficult. Let alone communicating, covariances, correlations, let alone, third and fourth moments, which they might be relevant in particular temporary.
And here we're doing the analysis at the fund level, which is not what an investor should be doing. An investor should,
I mean, I'm interested in what you've got.
Yeah.
Don't get me wrong. I'm just saying there's other questions to ask.
Right.
Here.
Maybe we can. So the problem, I think, is that we observe plan level data.
Mm-hmm.
So we don't know anything about the portfolio of a particular individual, which we would need to do that kind of analysis.
Outside their plan, investor.
Yeah, and we don't even know a particular individual in this plan. We just know the aggregate across all participants.